Meditators, today we have a special episode for you. Every week we talk to the most successful investors and traders in crypto, and we have compiled all the best alpha leaks specifically from the DeFi space into one episode. We talk about what DeFi is and why it is important, what the opportunities are, how to mitigate your risks, our guests' top secret tips on how to maximize our profits through DeFi, and how anyone can get started right now. Going back over these episodes made me realize how much I've learned from our guests, from traders at the world's best crypto funds to top educators in the space to even veteran developers, and I cannot wait to share this alpha with you. If you are as excited as I am, remember to like and subscribe below. To stay one with the crypto market, sign up and get 6 free market meditations newsletters a week. You'll find a link in the description below. A quick thanks to our partners Exodus for making this podcast possible. There will be more on them later. Before launching into how you can maximize profit in the DeFi space, let's take a listen to Ryan Adams, writer of the Bankless newsletter, explains what DeFi is and why it is important.
The big opportunity I think crypto brings is the opportunity for people to gain back control over their wealth, over the banking system. So that's what going bankless actually means. There's a verb component of it. The first thing we started doing in crypto with the advent of Bitcoin was one verb. It was hold, right? Like you buy Bitcoin, you hold it. Sometimes you pay with it, but those use cases have kind of fallen by the wayside. Bitcoin as a digital store of value is the use case that remains predominant. But with DeFi, there are all of these other banking functions that we can start to do, other money verbs, as we kind of call it. So in addition to hold, you could start paying people with stable coins. We do a lot with Bankless, and we have contractors, that sort of thing. Our medium of exchange is stable coins. It's not fiat anymore in the legacy banking system. You can also trade without a bank, basically use a Uniswap. You can take out loans using Compound. You can receive interest, and there's money markets. So all of these various money verbs is what it means to go bankless. And you start to realize what a rent-seeking institution the banks actually are. So we like to say the world really doesn't need banks. We need banking, but we don't need banks.
Now, let's dive deep into what opportunities there are for you to take advantage of. We had DeFi Dad, one of the top educators in the space, on the podcast to explain how you can earn passive income using DeFi through lending and market making.
Lending is easier to understand because I describe it this way. I actually just talked to a friend today about this. He was asking me, hey, I'm thinking about starting to dollar cost average into like Bitcoin and Ether. And I was like, cool. Just, reminder, buddy of mine, please don't come back to me if the price goes down. Like put in whatever money you're comfortable with and comfortable watching it possibly go down 50%. So what you end up doing then is, instead of just holding an asset like Bitcoin or Ether, and since we're focused on DeFi, this is all on Ethereum. So we don't have Bitcoin, the native token. We have pegged coins called wrap Bitcoin and synthetic Bitcoin. So anyways, back on Ethereum, if I hold an asset, the question is, why not use that asset to earn more of it? A simple example would be, if I own Facebook or Google stock, what if you could lend that Facebook or Google stock and earn more of Google or Facebook stock? That's how this works. There is a whole market out there that we've talked about here on Aave, Compound, BZX, DYDX. They are markets where people are actively borrowing and paying interest. So that to me is the simplest. I'm long Ether, I'm long Aave, I'm long SNX. I might as well lend it, because the part of it that is surprising, despite all the risks we talked about, is when you lend and you borrow in DeFi, all of the lending is currently over collateralized, which means if I'm a borrower, actually, let's say I'm a lender, I put up 1 Ether. someone comes along and they're a borrower and they want to borrow 1 Ether. They have to put up more Ether than the 1 Ether to borrow, which is a little confusing if you're new to this and not understanding that there's a lot of people wanting to put up value that they own. They have a store of value in Ether, wrapped Bitcoin, and they want to borrow stable coins against it to go lend those stable coins or use it. Maybe you need to use it for a bill. Maybe someone has a tremendous amount of money and they want to use it to like buy a house. I don't know. But end of day, if I own an asset, I can lend it and I am protected from credit risk. I'm protected from someone defaulting because if the borrower who has put up more money than the 1 Ether they borrowed, if they do not maintain their loan, if they do not keep a proper loan to value ratio going, then the smart contract has no emotion. The money software has no emotion and it will liquidate them. So it's a very like on the borrower side, there's no one to call and say, please forgive the fact I can't maintain this loan. It's just you screwed up, you broke the rules. If you break the rules, then this happens. Liquidate, sell it, and it means that I, as a creditor, a lender, am protected. So that's why lending is so popular. The other option that we talked about or that you mentioned is providing liquidity. So in DeFi, the reason that we're able to trade without middlemen, the reason that we often don't have closed order books the way that like a Coinbase and Binance works. We have pools of money with normally 2 tokens. It can be more, but normally 2. So we have Uniswap. Uniswap will have, let's say, Ether and DAI. DAI being a digital stable coin or a digital dollar. Folks deposit 50% of this, 50% of that. So now let's say today Ether is around like $1,600. If I put in 1 Ether, I would have to also deposit 1,600 DAI to maintain the trading rate. So I'm lending my liquidity, I'm lending my Ether and DAI. Every time someone trades, the money software Uniswap, when I go to trade, let's say Ether for DAI, it charges me 0.3%, 30 basis points. Now, let's pretend that the pool has $100 million in it. All of us that are lending liquidity or providing liquidity, however you want to describe it, all of us own a portion of the pool. We earn a portion of that 0.3%. So the numbers that matter here is how much liquidity is there? Let's pretend I have $1 million in a $100 million pool. If we do $20,000 of transaction fees today, I owned 1 million of the 100 million. So I own 1% of the pool. I earn 1% of the transaction fees. That's how like simple and like sort of frictionless this is. It's always a matter of how much of this thing do I own? I earn a proportional amount then of whatever fees are being collected by the money software. And people that use the money software are happy to pay that fee because we're all providing this service, allowing them to trade. So providing liquidity is very popular. If you go to zapper.fi.invest, zapper.fi/invest, that's the pool tab. And you can basically look up pools that have tokens you already hold, like Ether and DAI. And you could say, I'm going to provide liquidity and I would like to do this because I'd like to earn market making fees and possibly other rewards.
Today, some protocols out there are paying over 100% APY. We had 𝐉𝐸𝐬𝐵, founder and developer of DeFi protocol Saffron Finance, to explain why yields can be so high and therefore how you can take advantage of these.
Exchanges that were launched in 2020, DeFi platforms launching now, they are giving away their tokens to new users to attract them and to gain new users in the industry instead of having the APYs derived from actual economic activity. So for example, on Saffron, you can see the stablecoin APY or you can see the enhanced reward APY. So we are giving away rewards as well. A lot of protocols will tell you the APY. Really, that's an APY of combined economic activity plus their reward token. So they're just printing new tokens, or they're making a reward system available for the early days to attract users. And I think this is similar to, let's say, Uber subsidizing a lot of the ride costs in the very early days, and then eventually that went up, right? So this is a strategy that is not necessarily bad, but could backfire if enough economic activity is not given to the chain and not adopted on chain.
𝐲𝐬𝐬𝐬 also shared his thoughts on whether these high yields can persist in the future.
It depends on how much real economic activity can be passed through DeFi. So if people are taking out loans and they're borrowing based on these DeFi platforms, then the lenders will make more money than they will anywhere else in the traditional world. But if most of the, let's say, profits or the yield coming from DeFi right now is just being sustained by customer acquisition costs, then it will be a very hard crash. I think that DeFi as an industry needs to attract real economic activity before those customer acquisition rewards run out. Otherwise, we're going to see that crash.
So the opportunity in DeFi is huge, but what are the risks? We had DeFi Dad break these down for us.
Let's say I deposit some USDC. When I deposit that, what Aave gives me is called an A token. So it's essentially an IOU. But what is an IOU? An IOU, it's similar to like when I put money into a bank. If I put money into a bank, I don't own my assets. I own a credit note, on their ledger. And so this is very similar to that, except again, we've eliminated all of these middlemen. So I'm holding, in this case, an IOU that means that I am owed X amount of USDC plus interest. And by doing that, the risk, going back to your original question, what we want to call out is because I'm 100% in control, because we've eliminated all of these middlemen and maybe like, the traditional support that you would call, at a bank, it means that there's risk that I could lose my private key if I were to somehow lose access to my wallet and not have it backed up. Pretty standard for crypto, but for those that are newer to crypto, newer to DeFi, that's a foreign risk. If you've never used a Ledger or MetaMask or Coinbase wallet, which is another self-custody wallet, or Trust wallet, that's something that I think factors into why rates can be so high here. A few other things to consider are, could there be a smart contract bug? Could there be a bug in the code? That's the simplest way to say it. And the reason we consider that is, remember that the code at the end of the day is developed by human beings who are very imperfect, we know, and the code is audited by human beings and some automated software. And so there's still risk. There's risk that there could be a bug in this code that would allow someone to exploit the money software and take that money out.
And now that we've got some clarity on what the risks are, the question becomes, how do we assess them? Now, this is fantastic from Sam Trabucco, quantitative trader and risk management specialist at Alameda Research, tells us how one of the top crypto trading firms in the world assesses risk in DeFi.
Often the returns for these yield farms are incredible, but sometimes they're like a thing that popped up last night and somehow has like $1 billion on it, and it's like, what are the chances that this thing rug pulls? And yeah, it's a good question, and I wouldn't say that we have a great categorical answer to how we assess the risk of these things. So internally, we do have some team members who have a decent amount of experience evaluating the actual code bases of the projects, and in some cases, especially when we're considering putting a ton of money onto a platform, we will have someone devote a few hours to, or at least a few hours to evaluating whether it seems at least minorly likely that there's some exploit in the platform. But if it's just a smaller amount of money, at this point we feel like we have empirical an empirical probability that a given platform will default or have some exploit that causes us to lose all of it, and we'll take that probability, discount discount the returns that we're getting on capital by like that probability times 0, because if we sort of assume that if there's an exploit, we're losing all of it. And if it still makes sense, then we'll do it. And so we just sort of discount what we're making by some probability of losing all of it.
God, that's
and
fascinating.
so in EV terms, that sort of just checks out because like there's some like risk of ruin, but like I mentioned before, we're even for these, like, even if the opportunity becomes quite large, it doesn't tend to be large relative to like our total capital base. So it doesn't tend to be a problem for us.
So what is the percentage chance that Alameda Research attribute to the risk of ruin whilst participating in these DeFi protocols?
Say 1% or 2%. Once something has lasted a week without an exploit, that drops quite a bit.
One of the biggest problems in the crypto industry right now is that there are far too many applications and none of them are very user-friendly for beginners. That's why we've partnered with Exodus. They're a desktop and mobile wallet that allow users to own their own private keys, navigate a very easy interface where they can view their portfolio, store multiple different cryptocurrencies, as well as exchange and earn interest on those cryptocurrencies. So if you're interested in checking them out, head over to exodus.com. That's EXODUS.com. Now the section that we have all been waiting for, pure DeFi alpha from the best in the space. First, we have Crypto Messiah explaining exactly how to use on-chain analytics to inform your DeFi investments.
You have to be able to understand what exactly is happening on-chain. When I go to an address and, I can look at, different people that are holding, a certain asset that I'm in, and, I can literally follow all the breadcrumbs. I go to their wallet and I look at what else they're buying. And that's a really easy way for you to identify potential opportunities. And I've identified a lot of opportunities that way. As you go look at projects that have made it, you go check those top wallets and you see these whales and you go, what else are they in? Because this is obviously smart money. This is money that has been successful. This is money that's done research. I'm going to find out what else they're interested in, and that might be a nice trail of breadcrumbs that I can follow. And I've identified several investment opportunities in that way alone. And that doesn't require any kind of subscription to a service. I know a lot of people probably can't afford something like Nansen, which is $1,000 a year. If you can't afford that, and if you made money, I highly recommend getting it because Nansen actually takes that to the next level. I can not only do that thing where I look at the top balances, but over the last 7 days, 30 days, I can look at the top transactions. I can follow the money flow. I can see, what these people are doing. Are they flowing into something else? Are they just selling and sitting on their dollars? I can look at the top balances, the rich list, if you will, and I can see over the last 7 days, is all the smart money, are they selling here? Are they buying here? It gives me some historical context to what I originally described, which is just going to good shit, looking at the whales and seeing what else they may be interested in, and then looking at the market caps and other things and seeing if that fits your investment criteria.
Then he shows us how we can apply metrics from traditional finance to DeFi protocols.
Another really cool tool that I've been using recently is called Token Terminal. It's totally free. And it actually provides TradFi or traditional finance metrics for DeFi projects. It tracks 7-day and 30-day and daily revenues for a lot of these projects, which is really interesting. It also tracks PS ratios, which is essentially a market capitalization divided by the revenue of the project forward projected over a year, which is a really, really interesting statistic because it allows me to compare things on a relative basis. It normalizes everything that I'm looking at and standardizes everything. So for example, 𝐏𝐨𝐬𝐧, which is something that I've been talking about for a while and that I'm extremely bullish on. I go look at 𝐏𝐨𝐬𝐧 and I look at the 7-day or 30-day revenue for 𝐏𝐿𝐴, and I see that at a $180 million market cap, 𝐏𝐿𝐴 has produced I think it was $7-8 million of revenue. And then I can go look at something like 𝐉𝐴, which at a $6 billion market cap has produced maybe $5 or $6 million of revenue over a 30-day period of time. And you have to start asking yourself questions then. on a relative basis is something, if all things were equal, and I know they're not, because there's so many other things that factor into this, the strength of the community, the token economics. There's literally a million different factors, but let's assume all things are 100% equal. And I just want to compare these on a relative basis. I can look at those kind of statistics and I can say, well, 𝐏𝐸𝐽𝐺 might be, just based on that alone, 𝐏𝐸𝐽𝐺 might be extremely undervalued compared to 𝐴VE, or maybe it's that 𝐴VE is extremely overvalued relative to 𝐏𝐸𝐽𝐺. But there is that spread there that can contribute to your investment decisions. Another one of those is �keeper DAO, which at $1 billion market cap is doing like $9 million in revenue over 30 days. And then you got things like 𝐴VE. But even then, you're not comparing apples to apples, because 𝐴VE is a lending platform and these are not. One is an options platform and one is an MEV extractor. But that's kind of the way you have to think about this. Another way you can think about things on a relative basis are just comparing market caps, understanding in the current market conditions what kind of market caps make sense. Right now, the best DeFi projects seem to be around $5-6 billion cap. So maybe you come in and you say, well, I think that this is one of the best DeFi projects too. And I have put together a thesis that this is going to gain significant adoption, that, it's going to get market share. The revenue has been trending upwards, which you can track on Token Terminal. So just on that basis alone, I'm looking at this at a $500 million cap. And I think that maybe this has an opportunity to go to 5x from here, 10x from here, whatever. You got to understand that the market is absolute insanity. But looking at things like this gives you perspective on what levels of insanity that the market has priced in and the market has accepted. So if I can look at these extreme cases already, and I can look at places where the market has said, this does make sense and the price reflects that, it gives me an opportunity to identify other things where the market maybe hasn't priced that in yet, and also a benchmark as to where the market might price these things.
Next, we have Sam breaking down how Alameda Research decide to allocate their capital.
The way that Alameda's trading works in general is like we have this capital base, and we have like a ton of things we could be doing with it, and so some fraction of our capital we're going to want to park in like all the collateral accounts of all of the different derivatives, because the opportunities that exist there make us like X% per day on the capital that we tie up. And this is true for like every possible place we could put capital. We have historical returns that we can look at. We like have intuitions about how they're going to change. But like basically every place we could have capital has like some value associated with it. And so like we like have dug into like, oh, like this is like putting like all of our dollars here would make us this much or like whatever. And like we've calculated like, oh, this is and like so like every day we're like calculating, oh, we should move capital like between these two places. So everything we could be doing has dollars associated with it, and that's true of yield farms as well. And so basically what we're doing with yield farming is we're looking at all the popular yield farms and all the like pools within them, or like whatever the specific mechanics of a given platform are. And we're looking at how much we could make by putting X dollars into it. And if we could make more money by doing that, then by like having extra money in our trading strategies, we'll divert money from our trading strategies into yield farming.
Our final piece of alpha comes from Jason Choi, general partner at Spartan Capital, a $200 million crypto fund who runs through the best ways retail traders and investors can gain exposure to early stage DeFi projects.
This is not financial advice, but in terms of the opportunities that retails have, it really depends on your risk appetite, right? So most of the fair launch projects, they are by definition just being launched. So they're early on in their life cycle. There's probably more risk. You have to de-risk whether there is product market fit. You have to de-risk a lot of technical things that might not be figured out. You don't know if there's going to be a bug, 3 weeks into the contract launch. So those new launches are typically a lot more riskier than projects that have more of a Lindy effect. So projects that have been around for maybe 6 months or 12 months or 24 months already. So those tend to be valued at a bit of a premium. So things like Compound, 𝐴VE, products that have been around for a while. but they are relatively lower risk than a completely new lending protocol that comes out. So I think there's no kind of one thing that retail investors should look into. But if I were a retail investor looking into the space and I have, a relatively high risk tolerance, I would spend some time looking into the newer projects and not just kind of investing in them, but really jumping into the Discord and giving suggestions, even early feedback on the products as users. Those things are incredibly helpful for founders. And I think a lot of folks that I know who did that early on managed to identify huge projects very, very early on just by being early kind of community participants. So projects like Synthetics, if you were kind of an early Discord participant, you're probably a really happy person today.
We've run through what DeFi is, why it's important, the opportunities, the risks, and shared our guests' top tips. But how does one get started? DeFi Dad explains step by step exactly how to start using DeFi on the Ethereum network.
The way that we do that is if you use something like Argent, Argent actually has banking relationships where you can take your fiat and then ultimately buy something like Ether. Because when we use DeFi, DeFi that is built on Ethereum, at the end of the day, it doesn't cost you anything to access it, but you pay incremental network fees as you use stuff. So if I were to go do a lending transaction, if I were to go deposit my money, I pay this fee that is in Ether. Ether is what's used then to basically pay people who support the network to confirm my transaction on the blockchain. So I would think of it this way. Imagine if instead of paying a subscription to Netflix, that every time you watched a movie for however many minutes, you were incrementally charged for that. That's the way that Ethereum works. You want to lend this? Okay, pay a little fee to do that. If you don't do anything now for 30 days, there's nothing to pay. You're just lending your money and earning interest. One of the easiest things to do then is just swap or trade. Swap is a term that we use in DeFi, but it just means trade. Trade some Ether for another token, something like, this isn't financial advice, but go to somewhere like DeFi Pulse. DeFiPulse.com has a ranking of all the different applications based on how much money is deposited into them, total value locked, which to me it's indicative of use and I would argue underlying value. So let's say, for example, if I was going to trade some Ether, the native token of Ethereum, for Aave, the native governance token of the Aave borrowing and lending protocol, I could go to, this is where Zapper comes back into the picture. So you go to zapper.fi. First off, connect to your wallet. You can see everything in your wallet. So this now becomes where you track your entire DeFi portfolio, whether you're lending, whether you're simply holding tokens, whether you participate in an insurance market, it's all there. And it's updated in real time. And best of all, this is something that you have to point out to folks that are new to this space. There's no sign up. You just connect to your wallet. We don't collect any data. So we have a very strict policy of you have some data stored locally on your computer so that it loads faster, but we don't store anything because this is Web3. This is the idea of we're giving you the ability to use applications without having to recreate your identity and give us your personal address and your email and all that bullshit. So you go to Zapper, track your portfolio, click on the exchange tab, and then this is what is called a decentralized exchange. It's an aggregator of all the different trading platforms in DeFi. So essentially, it's a Google search engine for trades. It'll ensure you get the best rate. And then you can choose to swap or trade your Ether to just look up AAVE in this example, or wrap Bitcoin. It tracks the price of Bitcoin, but it's on the Ethereum blockchain. And that's it. It'll take one transaction. You want to go to gasnow.org that I mentioned earlier. Check the gas price and consider, how quickly do I want this transaction to go through? What am I willing to pay? And as you change the gas price, you'll notice how much more or less money you pay. I will say, hopefully by the time someone listens to this, I hope gas prices go back down to below 100 𝐴. This 300 𝐴 stuff is ridiculous. I'm not even doing anything today myself. the prices are up 3x compared to what I would normally pay under 100 𝐴. So that's it. So that's trading. And now once your transaction goes through, you'll be able to see that on Zapper. So on the dashboard, you'll see Ether and let's say 𝐿𝐴 or whatever token you buy.
One of the main issues with the Ethereum network right now are the gas fees. These make it really difficult for newer participants to get into the market and start using these DeFi protocols. 𝐻𝐸𝐵 therefore suggested a few other options alongside some great resources for anyone to learn more about DeFi.
Right now, I think someone who's getting started, it would be hard for them to get interested in Ethereum because the gas fees are so high. I would say watch for something to happen where either Ethereum layer 2 gets announced or there's an update to Ethereum where gas fees get lower. Right now, it looks like chains like Phantom and chains like Binance Smart Chain, even Avalanche, are becoming more popular due to the low fee and their introduction into DeFi. So actually, if you're interested in learning about DeFi and seeing if you can invest in it or seeing if you can understand how these new concepts apply to finance and how that applies to your life, look at what the new platforms are doing and look at how much it actually costs to transact on those platforms and see the return rate that others are getting and maybe look at exactly how those returns are being generated. If they're being generated by rewards or if they're being generated by actual economic activity, it's good to look into that. So yeah, I would say look at some of the new things that are coming out that are solving some of the problems that DeFi has right now, which is high transaction fees and just kind of hard to understand where that money is coming from. If you do a little bit of research, I would actually suggest our own Saffron Academy, which is coming out with videos, DeFi tutorials, things like that. I actually really like Binance. I think it's called, what is it called?
Binance Academy?
Is it called Binance Academy?
Yeah.
The Binance Academy is really good. In fact, if you want to learn about AMMs or impermanent loss or any of these technical concepts that get thrown around a lot, you can probably just Google Binance Academy and then the search term, and you will find a very good explanation of what's going on. Those two resources have been really helpful to understand how to learn about DeFi for a beginner.
DeFi has been one of the hottest narratives of this bull market and is the first time we have seen crypto projects being backed by real revenue. Getting some of the top minds in the space to share their alpha was awesome, and I hope you enjoyed this episode as much as I did. The speed of development in DeFi can make it difficult to stay up to date. So that I can keep track of the space, I have my team of researchers write 6 free newsletters a week. To access this, all you have to do is sign up at 𝐏𝐸𝐴𝐾.substack.com. If you enjoyed this episode and want to dive deeper, check out any of the original episodes. For complete beginners, I would recommend How to Earn Passive Income Through DeFi with DeFi Dad. And if you want more advanced crypto gems, networking, and finding happiness with Crypto Messiah is a great episode.